Can you show a real-life example of a delta-neutral strangle? If you are curious about how a delta-neutral strangle works in real life, you are in the right place. Let's break it down with a practical example that illustrates this advanced options trading strategy. A delta-neutral strangle is designed to keep your overall delta close to zero. This means that small price movements in the underlying stock will not significantly impact your position. To set this up, you sell a call option and a put option with different strike prices but the same expiration date. The goal is to balance the positive and negative deltas so they offset each other. Let's say you are looking at Boeing, which trades around $180. You decide to create a delta-neutral short strangle. You sell a $165 strike put option, which might have a delta of about negative 0.2. Next, you sell a $200 strike call option, which could have a delta of about positive 0.2. By selling both options, you generate premium income. The delta of the put option is negative 0.2, while the delta of the call option is positive 0.2. These two deltas roughly cancel each other out, resulting in an overall delta that is close to zero. This means that small price changes in Boeing will not significantly affect the value of your position at the start. For instance, you might collect around $3.63 per share in premium from selling both options. Since one option's contract typically represents 100 shares, your total premium income would be $363. You would use approximately $2,000 in margin for this trade. The maximum profit you can achieve is the premium collected, which is $363 per contract. However, if the stock moves beyond the strike prices at expiration, your risk is limited to the difference between the strikes minus the premium received. Traders use a delta-neutral strangle to profit from the underlying stock remaining within a certain price range until the options expire. Since the position is delta-neutral, it does not depend on the stock moving in a specific direction. You can benefit from time decay as the options lose value if the stock price stays between the strike prices. It is important to note that this strategy works best when implied volatility is high. This allows you to collect higher premiums when selling the options. If the stock moves sharply, your position may become imbalanced. In such cases, you might need to adjust your position by buying or selling shares or other options to maintain delta neutrality. In summary, a real-life delta-neutral strangle involves selling an out-of-the-money put and an out-of-the-money call with deltas that offset each other. For example, selling a $165 put and a $200 call on Boeing, trading near $180, generates premium income while keeping directional risk in check. This strategy is aimed at profiting from range-bound price action while managing risk effectively.